Hello, my name's Charles Lastic. I'm the Managing Director of Blue Bond Tax Planning. I've been helping clients save millions of pounds in their inheritance tax over the last 18 years, and effectively today's video is around family investment companies, and the question is it easy to manage a family investment company on a yearly basis? Hello and welcome back, and today's video is around is it easy to manage a family investment company on a yearly basis. So very simply, a family investment company is a normal limited company with the Articles of Association changed at the outset and shareholders, very strong shareholders agreements set up which are altered to suit the needs of the company. So effectively it's run, and the running of it is the same as any other limited company. So the question is what have you got in the company as opposed to how difficult is it to run? So same as any other limited company once it's set up. Now, once set up, by changing the Articles of Association and writing that strong shareholders agreement, the running of the family investment company is, as I say, the same as any other limited company. Exactly the same tax rules apply, so there is no difference. That's the point to get home. Now, most family investment companies are investment companies as opposed to trading companies, and so the capital shares are subject to inheritance tax. And so are any unpaid directors' loans where people have put money into a company and got a director's loan. So that is still subject to inheritance tax. So if you have 20 properties in your family investment company and it's managed like any other portfolio in a limited company, and all the returns are done in exactly the same way as any other limited company. However, if your family investment company owns, say, shares, and you own companies which don't pay any dividends, right, tax is only paid when you sell the assets. So the assets grow gross, same as any other limited company, and therefore there is almost nothing to do in terms of tax returns and declarations of corporation tax, because there is no return inside the company until you sell one of your shares. Okay, so those are the two extremes. One where you've got lots of properties and things like that. Generally, though, even that we would set up as a sub-company to the family investment company. That's another video anyway. So it's the two extremes. Everything falls between those two lines. And the answer is, on how hard is it to run a family investment company, it depends on the assets that the directors hold in that company, and also, of course, if that company owns any sub-companies. So in summary, I think I'm ramming this point home now. An FIC is exactly the same as running any other limited company. The tax rules are the same, everything else is the same, but usually because it's an investment company, IHT would be payable on the capital shares. However, this problem is solved by giving away the shares directly, right? And those would be potentially exempt transfers. You would need to live 7 years, or if there's big capital gains tax issues, we could give the shares into an employee benefit trust, and that would defer that capital gains liability for 50 to 100 years over long the company ran, frankly. Now, employee benefit trust, I'm not going to go to, that's a whole separate video, but really, in summary, a family investment company is no more difficult to run than any other limited company. It depends entirely on the assets that are held. Okay, hopefully you found that useful. If you did, give us a thumbs up and a like, would be appreciated. Thanks for listening, and goodbye for now. Bye.